Great. Kalimera to everyone. I'm sorry we can't be in Cyprus this week. We would love to be able to travel again. It looks like a gorgeous weekend of weather coming up. And I'm hoping that if you all start using our MAELA measurement service, you can actually take the weekend off, not work, and you'll probably save so much time that you can take next week off as well. So it'll be nice to be able to extend the July and August holidays into September and October as well. Anyway, we're here to introduce MAELA, the world's first accounting measurement platform. And we thank Harry and Mariette for putting this together so quickly. And yeah, we'd like to run through what we've put together and how easy it is to work and what kind of things we do. And then also to run through how to be effective with your IFRS 9 expected credit loss calculations, how to collect the right data, how to then look out for some of the pitfalls and some of the tips and tricks to make you more successful at it. Not all of this relates to our product. There's a whole lot of knowledge that will help you whether you use our product or not. And we also have a whole lot of templates that you can download that will provide you with an Excel framework to collect the appropriate data. So we may have met some of you before on some of our previous trips to Cyprus or on some of our other webinars. We spoke at an Institute webinar earlier this year on IFRS 9. Anyway, my name is Rosh Siegel. I have a history with Caseware, and then we started i9 Partners, the IFRS 9 company, and have now built MAELA.biz, which is our measurement platform. In case you're curious, the name MAELA comes from the Icelandic word for measure. So we're all about accounting measurements, and that's what we specialize in. So why have we done this? So a whole lot of IFRS measurements have become really complex, specialized, and costly to perform properly in-house. So some people do the calcs anyway, but it's really tough to actually do them properly because of all the nuances behind it and the body of knowledge that's required to make judgmental calls. It's not just putting stuff into an Excel template and seeing the number pop out. So what do we provide? Well, we're an accounting measurement platform. We're starting with IFRS 9 ECLs, and once you subscribe on our website, we'll also notify you of other measurements that we are providing. There are a couple of others that we do provide at this stage, and also for you to provide us with ideas or requests in terms of other areas that you need. How do we do this? Well, we're the first online platform to be able to do this. We license a whole lot of data and models and find experts in the various specialized areas and bring that all together onto our MAELA platform and automate it in a way that makes it accessible, but also makes it very convenient and a lot more affordable than actually doing this yourself. Our expertise are leading specialists with real-world experience, and that's really important. We interact with a lot of organizations that have tried to do this with IFRS advisors, and the reality is that we don't give IFRS advice, and you can really see that IFRS advisors are remarkable at interpreting the really, really complex world of IFRS. I certainly couldn't do that. But in reality, they are very specialized, and we're specialized in a different area. It's the real world application of IFRS 9 and other measurements. We have proven methodologies that have been built up through collaboration of doing tens of assignments and thousands of calculations And we do a lot of those together with the big four firms. We deal with their specialist credit teams, and we have frequent meetings with them to make sure that we're all on the same page and that everything gets done in the most efficient way, and very importantly, in a way that makes it easy to produce audit working papers and to audit them. So how much does our service cost? You don't make a subscription, you pay as you need it. There's a fixed cost per measurement. It includes all the data and models that we use. So for example, where we use a Moody's rating and we convert it to an ECL, we pay Moody's for that. In the background, we buy these tools and models at bulk rates, and that makes it really affordable, where most firms, in fact, very few firms, could afford that by themselves. And certainly companies, unless you're a major financial institution, wouldn't be purchasing those models at tens of thousands of euros. And it's based on the item that you measure. Some items are cheaper than others, and it starts from about 35 euro based on bulk, and it also is based on the level of assurance that's required. So where you need where it's quite complex and material and risky, you may want an analyst to look over it, and having the analyst look over it would provide you with additional insight and confidence, and that would have a slightly higher cost. So we do accounting measurements. The platform is available globally. You can use it from any country, and you can measure the ECL on an asset located in any other country. So if you've got companies in Cyprus with investments in Europe, or loans that are owing, or debtors in other countries, we can measure all of those as well. Starting off with IFRS 9, the measurements will suit your budget and your requirements. You also have access to our experts. So it's not just the web service, and there'll be more to follow, and we'll let you know as those come online. So our first speaker is Lawrence Milner. Lawrence is co-founder of I9 Partners, our specialist IFRS 9 partner. He's led over 80 major IFRS assignments. He's also CEO of CI, South African leader in credit intelligence, that run a team which would process thousands of expected credit loss calculations a week for major institutions, and has got over 25 years of experience in credit and credit outsource services through Moody's, where he was based in Europe and started their South African office, and also through FirstRand Group, one of South Africa's largest financial institutions. Lawrence.
Morning, everyone. There's a picture, and here I am in real life. So what I wanted to talk about is just a few practical issues relating to IFRS 9. So I want to talk about this issue of your calculations standing up to scrutiny. How do you make sure that your calculation will withstand a test of someone saying, is your answer right? And then just a few practical tips and tricks. So measuring expected credit losses, it's a strange one because there's so much maths behind it. We're always trying to put a formula behind it, but it is not a science. It is very much a combination of a science and an art. So always bear that in mind, that it does require judgment to get to the right answer. A few practical things that I want to mention is IFRS 9 does give some worked examples within the second part of the statement. Those are examples. They are not recipes. And what we mean by that is you can't take those examples and force them onto other sets of conditions. They will only work where the conditions are the same as the example used. They do represent common scenarios, but don't try to replicate the IFRS 9 worked examples as is blindly. You need to be able to justify your answer. And if you're just going to follow their examples, you're not going to be able to do it. You need to make sure that you are taking into account all the relevant facts, but you need to apply the right technique on how to measure the credit risk related to the type of risk that it is. And the type of risk will depend on the nature of the counterparty, the other party that is going to repay the cash. And what we will often say is look at where that cash flow originates from, because that helps you understand what is the risk. And we need to make sure that you are measuring that risk appropriately. There are going to be judgments because sometimes it's not very clear what the real risk is and what the possible variations in the cash flow can be. You shouldn't be guessing. Where there is uncertainty, there are established frameworks, because these types of situations have been encountered many, many times before, and there are certain frameworks that you can use to make sure that you get to the right answers. And bear in mind that with IFRS 9, there can and usually is more than one correct possible answer. But just because there are different possible answers doesn't mean that every answer is correct. And there are certain answers that are obviously wrong. So take that into account and make sure that you don't have a wrong answer. In several areas of calculating expected credit losses, we look for correlations. We're looking at a relationship, a cause and an effect. Now, in order to do that, we are in the normal situation of trying to understand relationships, statistical relationships, mathematical relationships between different factors. And as in any type of measurement, you need sufficient sample, and that means you need enough examples and you need sufficient history. So be very careful of assuming a causal relationship based on 1 year's worth of data. You are not going to have an answer that you can defend, because straight away someone is going to say, let's have a look if we looked at 5 years worth of data. And the reality is we would be fairly certain that you're going to get to a very different answer if you look at a 5-year history of correlations as opposed to a 1-year history. So the question then comes, what happens if I only have 1-year history? Well, the only way to really answer that is we shouldn't be trying to look at correlations if we have such a limited history. So we should be using other techniques, and there are other very good techniques. You should also try to avoid looking at a single factor to describe everything. So one of the areas where we usually look at correlations within measuring ECLs is in the overlay of the forward-looking macroeconomic variables. A very common mistake made is to take one macroeconomic variable and work on a forecast for that. Most common being a forecast for GDP, gross domestic product. What is the economy growing at? And that being the only measure of credit risk. So what I would actually say is GDP is a very good measure of future credit risk. Credit risk does tend to change with GDP, but the second you add other factors in addition to GDP, you start to get the very important nuances. So if you were on a GDP only model, just think what would have happened. 2017, 2018, 2019, going along, everything fine, getting some very nice forward-looking ECLs. Come 2020, and what happens to your ECL provision? Well, it absolutely should have increased because the risk in the global economy increased enormously with COVID. But if you are going to have an increase based on an 8, 9, 10% decline in GDP, wow, look what's going to happen to your expected credit loss provisions. Then, bigger problem, come 2021, and your economy rebounds. We're now going back to capturing all that lost GDP. You're going to have as close to zero ECL provision. And I think that most companies would be quite reluctant to release their entire ECL provision, saying that there is zero risk on their book. But if you followed a pure GDP single factor correlation model, you would be stuck in that scenario. Can we just move on the slide? Oh, sorry, there we go. Thanks, sorry about that. So on loans, there are a lot of pitfalls that we can come up with, particularly on related party loans. And this is a very tricky part of IFRS 9. So a lot of related party loans are either not documented or they are poorly documented. And what I mean by that is there might be some sort of loan agreement, but because it's a loan agreement between related parties, a lot of the terms are just understood and they are not documented within that agreement. So one of the important distinctions to make is a loan which is repayable on demand, as opposed to a loan which has no fixed terms of repayment. The two are not the same, and they can be very, very different. A further factor to consider is that a loan that is seemingly described as repayable on demand, it might not be repaid immediately. There might be further factors that alter that agreement. What do I mean by that? Well, very often there would be an agreement entered into with a third party, such as a bank lending those entities money, that those loans cannot be repaid until the bank has been repaid. Maybe because the company is technically insolvent, if we treat those loans as pure liabilities, some of those loans have been subordinated. In other words, they cannot be repaid until all the other creditors have been repaid. So if that's the case, a loan which might be described in a contract as being on demand is not actually on demand. In IFRS 9, for the ECL, an on-demand loan, one that genuinely is on demand, where there are sufficient highly liquid resources to repay that loan, we would assume that the ECL is very, very low because the term of it is very, very short. It's due now and it can be repaid now. But you do need to take into account that that might not be the only loan, and I cannot be double counting it. So there are quite a few things that I need to take into account to assess whether the cash or very liquid resources reflected on the balance sheet are actually available to repay that loan. The term of a loan might not always be what the legal term is. And what do I mean by that? Well, sometimes there is no term stated in the contract, or the term is a day or 7 days or a year, but it's a loan that we know is going to be rolled over. It's going to be renewed over and over again. We call that a behavioral term. And very often the behavioral term is different to the contractual term. And the behavioral term can play a very important part in determining the actual ECL. So what I would say, I did mention this concept a moment ago, but very important from a loan perspective is, in order to understand where you should be measuring the credit risk, always follow the money. What is the source of repayment of that loan? Where is the cash flow going to come from? Which entity, and how's it going to generate it? And it's the possible risk, the variations in the cash flow that that entity can have that is going to determine the loan. We also look at, if there is a default, if the loan cannot be repaid in the normal course of business, what's going to happen? We call this the loss given default. Where's the recovery going to take place? Sometimes it will be 100%. In other words, you'll just lose everything if it cannot be repaid, but that's seldom the case, because normally there's some sort of a recovery period and some sort of recovery process. It might be just the loan cannot be repaid timelessly, and it is repaid, it's repaid very late. There is a loss. The loss is the time value of money. But on the other hand, there could be a realization of assets, some sort of liquidation process of the assets, and that would be used to repay the loan. And that brings up some very interesting issues on what is the value of assets under different scenarios. And in particular, if we look at assets such as real estate, so properties owned, inventory, and these kind of assets, the value under a forced sale is not the same as the value of a sale in the ordinary course of business. There is another distinction. We often talk about a fire sale. A fire sale is not the same as a forced sale. A fire sale is literally, we're going to hold an auction tomorrow, and the best price tendered is going to buy that asset. Whereas a forced sale is where there is pressure to realize it as soon as is practical. But in something such as real estate, a forced sale would normally take several months to realize. It could even take up to a full year. So you're going to get 3 different values on a property: a normal course of business sale, a forced sale, and a fire sale. And all 3 values could be quite different. Guarantees. So these are probably one of the most complex areas of IFRS 9 to account for correctly. The most common type of guarantee that you see in relatively small entities, and in particular non-financial institutions. So in other words, entities that don't make money from issuing guarantees. We see them through bank loans or loans from external parties that are made to essentially a group of companies. So because the companies in the group are separate legal entities, in order for the lender to be able to treat them as a single entity, they will often insist on there being cross guarantees between the different entities. We find that very often, talking to companies, they are not always aware that these kind of cross guarantees are a financial guarantee. You ask them, have you issued any guarantees? They say no. You then say, can we have a look at the contract that you've entered into with your bank for that facility? It's got different terms in different countries. It's called a bank facility letter in some, but there's always a contract that comes with the bank loan. And invariably, you'll find that if there are multiple companies within a group, there is likely to be some sort of cross-guarantee amongst the different companies in that group. Now, that brings up a whole lot of complex IFRS 9 issues. Rosh asked me yesterday, how best would you describe how to treat IFRS 9, a guarantee under IFRS 9? I said, probably the only way I can think of doing it is it's something like that Facebook status that someone you know invariably has, that their relationship says it's complicated. When it comes to guarantees, it's complicated. I can give you some general points, but they do vary depending on the nature of the guarantee. So some of the complexities that you need to look at is if there's a guarantee for banking facilities, you need to understand the term and interest rate of those banking facilities. Now, where it's a revolving facility, the term will not be the legal term, it's going to be the behavioral term. So if you've got an overdraft type facility, a facility that renews, typically the term is either overnight or 364 days. It's always less than a year. What you need to look at, you can't say that that risk is only for 1 year. You've got to say, well, we see that it is continuously renewed, and that behavioral term, how long you would expect it to be renewed, is going to be your term. The other factor that you need to take into account is the amount of the liability. What do we base it on? Where it's a fixed loan, we know the amount of borrowing because there's an amount advanced, and then we know how much has to be repaid, and we take the cash flow into account. We discount the cash flow at the interest rate to work out the ECL. But when it comes to, say, an overdraft, a revolving line of credit, that balance will change. Do we take the full balance? Do we take the balance at year end? Do we take the average balance? Well, it depends. It's complicated because we've got to look at what would be the liability if there was a default, because that's when the guarantee is going to be invoked. So I wouldn't automatically take the full facility amount, but I wouldn't simply assume that the year-end balance is the liability. What about facilities like guarantee facilities, credit card facilities, forward exchange contracts, all these types of facilities? There is something called a credit conversion factor. How much of that facility would you expect to become realized? And what we would typically look at there is the averages for the banking industry. So what they have is they have issued thousands of these types of facilities. They know on average how much is utilized at a point of default, and that credit conversion factor is important. A final point on guarantees that I want to make, which is really important, is covenants and covenant breaches. Where there has been a covenant breach, by definition, that loan is in stage 2, at least. It could be in stage 3. So if your client has issued a guarantee for another party's bank loans, and that party has breached a covenant associated with that loan. So the terms and conditions, one of very common financial conditions would be that the debt to equity ratio has to be within a certain range, or that there's a minimum amount of EBITDA that has to be generated. If that covenant is breached, the guarantee related to that loan is at the very least in stage 2, it might be in stage 3. Be very careful where your client says to you, no, we know we breached the covenant, but it's no problem. The bank has said it's okay. there is a very important distinction between a bank condoning a covenant. In other words, they say, you've breached a covenant, we've got the right to demand repayment immediately, but we're not imposing that. They are not saying it's okay. They're saying they've chosen from their own risk management and their own maximizing the value of that loan asset that they've got, they've decided it would pay them to keep the loan alive rather than call it up. That is very different to restructuring a facility to say that that covenant is no longer required. So if there is a breach with the condonation of that covenant, it should be stage 2. Right, I'm just trying to get onto my, there we go. Right. A few comments on trade receivables. A common mistake we see is they've tried to calculate the ECLs based on a 12-month history, a 1-year history. So I alluded to earlier, if you're trying to look at any correlations, 1 year is too volatile. What you might also find is that some months within that year are unusable. We often find we have to exclude a single month because transactions were processed late, so all your aging went out for a month. Receipts weren't allocated by to the debtors by year end, by month end, so there's a whole lot of differences. So if you only got 12 data points and you've got to exclude 1 or 2, you've got a real problem. So we would say that a 12-month aging history is never going to be sufficient. Another question often asked of us is, do we need to have a look at the detail of each debtor when it comes to working out payment history, or can we work in total based on aging? So it's a good question. Theoretically, it is possible to base it on total aging, but there are some quite important provisos to it. It's never going to be as accurate as looking at the flow of aging on a debtor by debtor basis and identifying defaults there. But it would be good enough where you have good quality data, where you have consistency. In other words, you don't have massive changes over the years, but very important to clean up that data. You couldn't possibly do it if it's including intercompany balances, it's including large amounts of credit balances. All these types of things need to be cleaned up if you are going to be using less imperfect data. I think it's important when you look at the data in any context on trade receivables to identify all the distortions. There's some quite interesting ones. What happens where you get some customers who pay you in advance? That means that you land up with very large credit balances at any point in time. That if you just include those in your numbers, you are going to get a wrong measure of what percentage defaults. So you need to be careful in how you treat deposits, credit notes, payments not matched to invoices, all these kinds of things. Sometimes you need to do a bit of cleaning of the debtor's book before you look at it. You will often see that you've got, and this is a key warning for these types of situations being anything more than a very occasional exception, is you see that the debt is aging shows a it's got a positive balance in 30 days, got a negative balance in 60 days, and a positive balance in 90 days. Now, when I see that, I am fairly sure that that means that there's been some allocation problem of payments to invoices. There have been too many payments allocated to 60 days, and that's brought it into a net credit balance. And some of those should have been in the 90 days, which means that we are going to be overstating our defaults. Another key point to take into account when you're looking at the debtor's aging is credit terms. So, do we need to take into account what are the credit terms of the specific debtor? Can we do them in general for the entire company? So, what I mean by that is, if you sell on 30-day terms, up until 30 days is not yet due. If it's 30 days, that is current. If it's 60 days, that would be 30 days past due. So if we are basing the definition of a default of 90 days past due, it would only be reach a default point at 120 days past the invoice date. So if I treat it consistently, it's not going to make an enormous difference. It will make some difference, but what will happen is I could potentially be overstating my defaults because I measure it as default when it hit 90 days, whereas in fact, it's only defaulted when it hits 120 days. So I overstate my defaults, but I would also be overstating my recoveries post-default. So I should be concerned about it, but the difference that it creates is not as big as one may think. Where you have different credit terms for different debtors within their portfolio, that's where it becomes a bigger issue, and that's where I might have to give it some attention and adjust specifically for the credit terms. A final point that I want to make on the trade receivables to watch for is you always need to know what were the actual bad debts. Now, these are hard to identify. You ask the client, what were the write-offs? So what you find is that the write-offs recognized by clients vary tremendously, and it's hard to explain why. Some companies like to write off very, very quickly, and in fact, sometimes too quickly. So they raise as a bad debt, they remove as a debtor, and then they make a whole lot of recoveries post write-off. Other companies like to keep it on the debtor's book almost indefinitely. So 5 years after the event, it's still there. And if you ask them why, should have written it off, they will say no, because it reminds us that we still need to be chasing after it. So, which is right? There's an element I can sympathize with both of those views, but what it means is that when you ask for your client what were the bad debt write-offs, you're not always going to get an accurate number. You might need to probe more carefully, and you might need to introduce some rules that say once it goes past a certain date, it is a write-off regardless of whether the client recognizes as such.
Perspective, having run hundreds of these trade receivables models and collected data from all of those clients, the one thing that we found is very few clients will actually understand and give you the correct bad debt or write-off figure. Even if they think they understand, once you start to probe, you actually see that they haven't. They also struggle to understand the concept of non-IFRS 9 provisions, where they increase it, they would normally debit their bad debt account, and when they decrease it, they would normally reduce that. So very often they confuse the movement in their provisions with the actual write-offs. We need to know the write-offs that come off the actual age analysis. Now, different techniques require different amounts of work. So if you're looking at only 12 months worth of data and you're only looking at totals, it generally doesn't take that long for either the client or for you to prepare. You could just take the totals, paste them underneath each other, and you're probably finished in 5 or 10 minutes. However, we know from experience, after comparing the results of doing that versus the results of doing that over a 5-year period with different rules to deal with the credits and the negative balances and the months you can't trust, versus doing it at an account level detail using 12 months data is a problem. You also get tremendous amounts of volatility. And that volatility really shows you that you aren't getting the right answer, that there are so many distortions that are in the data that you really can't rely on it. So the different techniques are where we use 5 years worth of data on a total balance basis. It's a bit of a pain to collect it in the first year. It's probably a couple of hours of work, but it's very doable. Thereafter, all you need is the additional months. So a bit of work in year one, but then it's okay. Now, using the totals, your probabilities of default are generally fairly accurate, but the loss given default is very, very difficult to find because practically in your 90-day plus bucket, or the oldest bucket, when you're doing it on an aggregate basis, you really lose track of which accounts have been outstanding for a long time. So your only real way of getting hold of that in a fairly accurate way is to look at it on account level. Now, account level basis is actually sometimes much less work because on our side, we've built an engine that will take 60 months worth of age analyses and just combine it as part of a process. We've then built further engines that suck it into a model, take out the credits, take out the negative balances, take out the strange items, the intercompanies, etc., and rebuild the aging on a per account basis to actually work out the correct answer. So pros and cons, but 12 months data is a real problem and we really advise against using it.
Right. So I want to just look for a few minutes at what is the appropriate measurement technique to use. So it's an interesting point because if you read IFRS 9, there are certain parts where it gets into a tremendous amount of detail of what needs to be taken into account in the ECL calculation. But for most aspects of it, IFRS 9 is nothing more than a rough guide. So what else can we look at to understand what is acceptable practice on credit risk? So the best possible source is the Basel regulatory framework for banks, because that is a regulated framework that's been in place for more than 20 years on how to accurately measure credit risk. And that goes into tremendous detail of each different type of asset. And that will, so where IFRS 9 doesn't tell you specifically and just says you need to measure something and doesn't tell you how, the most credible source of a technique, what is the acceptable technique, is that Basel regulatory framework. So that's the good news, that there is a source. The bad news is the Basel regulatory framework is long and complex. So if you say, well, I'll just read it, well, it's a bit like a banker who's not an accountant saying, I've been told that something has to comply with IFRS. Where can I read it? So you need to work through this document that in itself was hundreds of pages long in the original form, and since then has been several thousand pages added of interpretations and updates and new scenarios. You need to know what to pick out that's going to tell you how to value a particular asset. The technique tends to vary based on the type of financial asset. So a debtor is often going to be treated, a trade debtor, a trade receivable will be treated differently to, say, a loan. It will be treated differently to a guarantee. But where I said earlier, look at the cash flow. Where is the amount of money implicit in the financial asset. Where is the cash going to flow from? What is the source of it? That's going to tell you where you've got to assess the risk. So we've got to understand what is the nature of that counterparty, because different types of counterparties have inherently different risk. Consumers behave differently to businesses. Within businesses, we get certain unique risks of real estate, of the agricultural industry, all these types of things. You also need to understand the terms of the contracts. That's determine the basis of the cash flow, and the general environment. What country are we in? What economic environment are we in? All these things impact on my ECL calculation, and I need to know which to take into account and when I need to look at something. So if someone based in Switzerland owes you money, the country that they are based in is probably not all that relevant. But what happens if someone from South Africa owes you money? Well, the risk of South Africa at the moment is not so great. It's a little bit worse than Cyprus. Unfortunately, yours is also not so great. What it means is that I can't be treating a South African corporate, even if it's a big, reputable corporate with lots of cash resources, as the same risk as the Swiss government. And that is the reality. So if I'm dealing with a debtor based in a country with a high risk, the country is very important. If the debt is based in Switzerland, the country is irrelevant in my calculation. So for trade receivables, I'd like to point out that the simplified approach is mandated by IFRS 9, but if the simplified approach does not limit us to an ECL matrix. The two are not the same. The ECL matrix that's presented within IFRS 9 is an example of how you can do it. That matrix is relevant to a lot of organizations, but there are many trade receivables books that ECL matrix is not applicable for. So please understand that the simplified approach does not mandate the use of the matrix. Where I have a diversified book, so a large number of relatively small debtors, the best way to measure the risk is based on the payment history of that book over the past several years. Don't use 1 year. We've been telling you that several times this morning. Take a multi-year history and the payment's going to do it. If, on the other hand, I have a highly concentrated book, a small number of large debtors, I rather need to look at what is the risk of each of those customers rather than looking at the payment history on it. Because a single event, a lumpy event, a once-off event is going to have a big impact on the risk. So I need to measure my ECL based on the probability of that unusual event happening. What do I do when I don't have historic losses? Often happens. There is a business, they don't have a bad debt write-off. Doesn't mean I got a zero ECL. Well, probably not, because ECLs are expected. They're forward-looking. Just because it hasn't been in the past doesn't mean they can't be again. And I would say that there is almost always, not always, but almost always, a risk of future defaults. So I think that it's going to be seldom that there's going to be zero just because they haven't been in the past. It could be very low and you could determine that it's immaterial. What do I do when I don't have much of a history? It's a new company, or it's a new market they're selling into. And that book is very different to everything else. I need to then look at the risk of those specific debtors rather than the risk of the book, or use proxies to do it. You need to take into account certain specialized industries. I had mentioned real estate and agriculture. And I've also mentioned the country. So we need to look at where are the debtors located and where there are international receivables book. You could well need what we call a sovereign risk overlay, some sort of ECL factor to take into account the risk of non-payment due to a payment moratorium imposed by a country. Now, you say, are those rare events? Well, no, they're not. There are several countries, some with relatively large economies, that ration foreign exchange and make it difficult for trade credit to be repaid. At this point in time, there are several countries in Africa and South America that are doing this, and that is not uncommon. Over the last 50 years, that has happened many, many times over again. So
the ECL matrix and the example that's provided in IFRS was really an early attempt by some of the people involved in the IFRS 9 standard team to apply a mathematical solution to a problem for which they had no real world experience. So what we see is that if you're actually going to do it properly, very often you get a very different answer to just trying to apportion a bad debt amount, which is very seldom the correct amount. And you get a very different result by apportioning that across aging, which is subject to all these distortions that we mentioned, and doing it properly. So even to do the basic matrix approach, if you're going to use totals, you're in trouble. What you need to still then do is start to go through and identify some of the major distortions, take out intercompany loans, take out significant government balances, which have got a very different risk, and also identify customers in credit and all these different allocation issues. Now, once you go through that process, you might as well have just put it through an engine like ours. It'll be much quicker, it'll be much cheaper, it'll be much more accurate, and it'll be a standard way of doing things. So there are a lot of benefits by having an engine that relies on, that takes advantage of economies of scale, and that has been developed to speed through the process.
Okay, so I'm going to just move through these things very quickly just to ensure that we've still got enough time. But if there's any questions that you've got about this, please feel free to ask them in the chat, or we will give you specific afterwards. So for intercompany loans, the right technique is very important to understand the term. Difference between a loan with a term, a loan with no term, and a loan repayable on demand. I've spoken about the SICA issues, I've spoken about the subordination issues, that will change the term. Okay, can I move on to the next slide? For financial guarantees, what we all know is, I've already said it's complicated. One of the reasons is that it doesn't just involve IFRS 9. We've got to determine the fair value upon origination, so when the guarantee was originally issued, and we've got to amortize that over the period of the guarantee, and we then compare that to the ECL measured at period end, and we recognize the higher of the two. So a whole lot of key questions. How do you amortize? Well, that's a third IFRS statement that tells you how to amortize these. Generally speaking, it's accepted to do it on a straight line basis. Although it's not perfect, it is clean and it's simple. I've spoken about the term for a revolving credit facility and the amount of liability on a revolving credit. A very complex issue arises where you've got multiple guarantors for the same loan, and that often happens in these cross guarantees issued for bank facilities. Do we take into account each guarantor completely independently of the other guarantors, or do we take them into account that there are co-guarantors and allocate the risk between them? Well, what I'm going to say is it all depends. Cannot give you a simple rule because we deal with different situations where sometimes it was appropriate to look at them independently. Other times it's very important to take into account the behavior of and risk of other guarantors. So specifically on the fair value, you do need to take into account the correlations in risk between the guarantor and the entity being guaranteed. That is a specific IFRS requirement. So you cannot ignore that point. So the whole issue of how much of a liability do we recognize amongst each guarantor is a very tricky area, and you need to keep your wits about you, making sure that you're complying with IFRS on that. I do want to mention to you that once we have determined the fair value on origination, we cannot update that unless there is a change in the terms of the guarantee. That stays as is, and you continue to amortize it. The IFRS 9 would kick in if the risk has changed, and that's where either the 1 year or the lifetime losses may now become far larger than the amortized fair value. I have spoken about a covenant breach.
Interesting analogy or example about this issue of cross guarantees and who needs to recognize it. Say, for example, I borrow a whole lot of money from the bank, and the bank wants Lawrence and Harry to be guarantors in case I don't pay. So I borrow €1 million. Lawrence has got a liability for €1 million if I default, and so is Harry. Who recognizes it? So the first thing is Lawrence hopes that if I default, the bank will go for Harry. Harry hopes that if I default, the bank will go for Lawrence. If the bank goes for Lawrence, Lawrence has got no contract with Harry to get the money back from Harry. So Lawrence may carry the whole loss. If the bank goes to Harry, Harry can't get the money back from Lawrence. So Harry carries the whole loss. There's very seldom an apportionment in that respect. Within a group, as Lauren said, it's slightly more complicated, but that goes to show that on on a €1 million loan that I take out, there may be more than an ECL of that full million between all the different parties.
So I want to very quickly, because we need to get enough time to show you the platform. I'm going to very quickly just talk about the data requirements and why we need them. So for trade receivables, I need to be able to work out whether I have different risk buckets, different segments that carry different ECL percentages. That's a specific requirement. So I do need to understand the nature of the debtors. I then need the information to measure the PD and LGD on the basic book. Typically, I'm going to rely on a history. I'm going to say to you that a 5-year history is probably the minimum desirable history. The more you get, the better. If you can get, and over time, you're going to be adding a new year to it. So you'll quickly get up to 7, 8, 10 years, which is not a bad thing at all. Can I do it on 3 years? Well, at a minimum, probably yes. I also need the history of bad debts. I need to identify individually material debtors, because if they go bad, that's a specific event. So typically, I'm going to look at a debtor making up more than 10% of the balance. I need to identify related parties included in trade receivables, because I'm going to treat them differently. Their risk is not the same as the general book. And I'll also need to identify the country of the customer to determine whether a sovereign risk overlay is required. One point I want to mention is if you're looking at a rating or a probability of default, you need to take into account the term of the probability of default. Over how long am I measuring it? So someone might say a triple B minus has a 1% probability of default. Over what period of time has that 1% been measured? Very often that's referring to a year. I might need to adjust that for the period of my credit risk. On intercompany loans, I need to understand everything about that loan. So, is there an agreement? What other factors will help me work out what is the term of that loan? How long is it for? How is it going to be repaid? I need to understand the origination date, because IFRS 9 says, has there been a significant increase in credit risk since the loan was originally granted? So I might have to go back many, many years to determine what was the risk then and has it changed, because if it's changed materially since then, it's a sicker event. If we don't know when it started, I would just start on year one, and then each subsequent years compare the risk to that. I probably need the financial statements at origination and at measurement date. I need to know whether there's subordination. I do need to know things such as the interest rate, the method of capital repayment, because they all impact future cash flows that have to be discounted in determining the ECL. Right, let's go on to guarantees. I have spoken about most of that. So where you're guaranteeing bank facilities, we need to actually understand the nature of those facilities. We probably need to get details from the contract with that bank. We need to understand what are the liabilities. We need to measure the risk of the entity being guaranteed. So we probably need their financial statements in order to determine the risk. And we also need that at origination date so that we can determine the fair value of that to amortize it. We also need to understand the structure. Are there other guarantors, and what is the correlation of risk of ourselves and the other guarantors? So that is all a whole lot of information that you will require to do a financial guarantee assessment properly. I'm going to talk very quickly about bank accounts. And I've also said fixed income investments. Sometimes they're not only bank accounts, it's anything which earns a fixed income rate would be treated in the same way. So sometimes it's only a very small ECL, but we do need to accurately identify where are those funds deposited, who has borrowed the funds from us. Very important to distinguish between a subsidiary of a bank and the bank itself. A branch is the bank itself, but certain banks only work through branches. Other have different subsidiaries in each country. Your risk would then lie with that subsidiary. If you're uncertain, look at the bank statement. The letterhead on the bank statement will tell you which legal entity those funds are deposited at. They will also usually tell you if there's a group guarantee. So if you have, say, a bank deposit of a particular bank in a particular country, if it's a branch, it is the bank. If it's a subsidiary, the risk lies with that subsidiary unless it says the main bank in the home country guarantees it. In that case, you're only interested in the main bank. You need to understand what country it's in, because that's where the risk is. We need to understand what is the term, what is the balance. But very often, these are placed in short-term deposits that roll over and roll over. So to work out the term and exposure, we also need to understand what is the expected usage of that cash. And you need to take that into account into determining how long I'm measuring my ECL for and how much I am applying that ECL percentage to. So I'm now going to hand back to Rosh, who's going to be talking about the impact of an error.
Thanks, Lawrence. To show you what can happen and the number of scenarios that can impact your first thought and will actually result in a completely different answer. So a first thought is a loan is payable on demand and there's enough cash to repay that. In which case, as Lawrence said, it's got about a 1-day term, and you would assume that the ECL is insignificant and would probably raise 0. And most audit firms would be happy with that, if those were the facts. So in row 2, there might be several intergroup loans that need to be serviced. So you would actually need a list of all the different loans that need to be serviced, add them all up, see if the cash is available. Can you then pay it? And very often you're going to get a different answer. So in other words, the company can't pay all of those obligations on day 1. So therefore, you can't have a 0% ECL. What you've then got to do is you've got to determine what is the term of that loan. So you would then work out how many years would it take to repay that loan. And one of the techniques that you can use and that we use is to look at the cash generated by the business in the last year, and simplistically to say how many years would it take to repay those loans. If the business is in stage 1, and say, for example, that term came out at 4 years, because at stage 1, you would only look at 12-month losses, and you may get a very small ECL of 2%. However, if that loan was subordinated until the bank facility is repaid, it then becomes 5 years. So we'd use the later of those 2 periods. If the repayment is behind other creditors, your LGD would increase because those other creditors would be repaid first. And if you've had a breach of bank covenants, it's now stage 2 at the very least, and you would look at lifetime losses, and lifetime losses over that 5-year period would be significantly more. So the probability of default rises dramatically each year. So you can there see that it's not so hard to get from a 0 to a 16. You've really got to understand and think through all the different issues. So I'd like to quickly show you our platform, MAELA. And as we said earlier, it's the world's first accounting measurement platform. Who are we? Multidisciplinary team of chartered accountants, actuaries, and credit risk experts. I myself come from a caseware background, among other things. We've spent a huge amount of time with programmers automating and putting together this entire platform. On the IFRS 9 side, we've got a 3-year track record of delivering ECL calculations for IFRS 9, passing audit by all the Big Four with thousands of measurements, strategic partnerships with credit industry experts, including Moody's Analytics, and we use a whole lot of their products and models to put out some of the numbers, and a combined 30 years of experience in delivering solutions to meet complex credit risk and IFRS with accuracy, efficiency, and cost effectiveness. And some of our team would come out of the Big Four as well, especially on the actuarial side. Our real mission is to save you time and cost and improve the quality. A real point that you can't see on that graph is at which point does your quality hit the point which it's going to be acceptable for review by your institute and by a board of directors and shareholders. So you really need to get to a level of quality and be able to justify things so that you can actually pass scrutiny. So our objectives are efficiency. We want to save you time, and to do that, you need to touch the data only once. If you keep on going back to the client for more and more questions and answers as you go, it racks up everyone's time and costs. We also want to make sure that it's technically correct. So the methodologies and the techniques need to be justified, and they need to match the facts. The third objective is to hit the appropriate level of accuracy. And IFRS 9 allows us to balance cost and effort with the benefits and the size of the account. So certain circumstances, you may want an analyst to look at it as well to work out, are there any nuances that a simple item is missed? And very often listed companies would have a very different view on what that level of accuracy and confidence is. And likewise, for high-risk businesses, the auditor would also have a different level of risk on that and want more work to be done, because if the business doesn't make it, the impact to the auditor, to the directors, and to the accountant who signed off on the financial statements is very, very different. And point 4 is to make it easy. We want you to find it easy to achieve results. We want to be able to reduce your stress, spend more time on the beach this weekend, but also to prevent repetitive client demands of going backwards and forwards. So point 1 in terms of efficiency is to obtain the correct data in the very beginning of the process. So you'll see this is just an example of one of our templates for a loan. There are a number of other items which we would look at, and this is an Excel template which is available off our MAELA platform, and it's freely available for you to use. We hope that at the end of the day you also use the template, put it through our platform, and we'll do the actual calculations for you. So you've also got to obtain very often ratings and financial statements and macroeconomic scenarios. When you look at a rating on a bank, especially if it's a subsidiary in a particular country, look at all these different ratings. So this is a very real thing. It comes out of one of the rating agencies. Is it a triple B? Is it an A? Is it an F1? What does that all mean? Which agency did it come from, and how do you map it to a PD, and how do you map it to an LGD? So the macroeconomic scenarios are also a challenge, and you really need to look at base case upside and downsides in terms of what may happen within the economy. So if there is another round of COVID and another wave and another variant, you know that there will be a significant downside from here. If they discover a miracle cure, there'll be an upside, but you actually need to base your predictions and your models on 3 different scenarios and weight them appropriately. Here are some examples of the PD term structures. So 3 months, if it's a 1.05, 6 months maybe a 1.69, and you can see that grows, so that if you move from a 12-month to a lifetime, you could be getting a PD which is 4 times the amount of a 1 year, and that's why that staging is so important. It's also important to work out what the LGD is based on all those different scenarios, and you may get very different numbers. So we also are working hard to provide you with a working paper, not just the number, but to lay it out in a way that prevents you from having to do a working paper manually as well. To be technically correct, once again, you need to make sure that you've got all the relevant information, especially on loans. And we've built decision trees that go into our programming. So we've got over here, this is just the example on working out a term, but there are 10 screens of logic, and there are more than 10 possible outcomes. So if you've got one loan, there are 20 data points in the spreadsheet that you see to collect the data. You can get 10 completely different outcomes. And you really need to have some experience to know what that's going to be. And I think every time I listen to Lawrence make a presentation, the one thing is really clear. He's got a tremendous amount of real-world experience. And you really think, as an auditor or a CFO or an accountant, a general accountant, how are we expected to get the background and the ongoing knowledge and the reading, etc., to be able to understand this. The appropriate level of accuracy and confidence is important. What's the purpose? Are you just looking for an audit range? Is it listed? Or if it's an accounting estimate for a company, you need to do a point estimate, an auditor can do a range. What's the information that gets used? A short period won't give you much confidence. The level of detail, if you're looking at trade receivables on an account level basis, you'll get much more confidence, and volatility will always take away from the accuracy and the confidence. You're not sure what you're going to get. There is always optional review by an analyst on our platform, and we would advise to balance that, and we're trying to help you balance that with cost. So our online platform is supplied through MAELA.biz. It's really, really simple to use. I won't even spend 5 minutes on this because it's so simple. We've got a templates area that you would download the relevant template and fill it in. We give you the results. You upload it. We prepare the results for you. We give you a proper expert report. We've got a team of people behind it, actuaries, credit experts, operations managers. And this is what the platform looks like. You would click on the little green button to create a new submission. You would fill out your template. You would upload it. You would choose the date, what measurement service you want, which relates to the level of confidence. And from a privacy perspective, from the client name or code, you could certainly use an internal code so that we never know what your client's name is. Everything sits on an AWS platform in Europe. No information leaves Europe. No one has access to that information, and the information gets removed once the calculation is actually performed. So how it works, you create a login, download a template, you upload the information, and we give you your report and the working papers. You get it from the website www.maela.biz. You click on the client zone, it'll take you through the registration process. As we said, we use Excel templates for data collection. You can download them all. We've got a demo template as well that you can upload, and we know then it's not a real thing and you won't be billed for that. You can play with it, you can share it, you can use it for your own internal purposes, complete the templates. There are instruction sheets and examples on each template. We also have FAQs and videos. We also have an email support line. Once again, you can use a code name for privacy. The report, this is the first 3 pages. You can see you get the numbers. It actually can run to 15 to 30 pages, depending on the type of asset that you're looking at. But once again, this is designed to be easy to understand, and it needs to describe the techniques, the methodology, and the assumptions very, very clearly. We start off with an executive summary, the terminology and the expert team. So there are experts behind it and you can rely on it. We describe the methodology, the basis evaluation, key estimates and assumptions, what the items are that are subject to foreign sovereign risk, and the ECL percentages in a way that enables you to deal with things. And on trade receivables, for example, we would give you the total results at the bottom, but then splits it up, highlight what are the credits that got taken, and the credits would increase the risk and the total exposure on your trade receivables once you remove them. So you need to work it out on the total. Which were the amounts that were subject to specific provisions and not ECLs? What are the intercompany items that get dealt with separately? What are the government items? Any selected material exposures? And in the rest of the book, which we call the general book, you would have different ECL rates relating to each one of those particular aging buckets. We then provide this to you, not just in PDF, but in Excel format as well, because very often some companies would want to run this on a monthly or quarterly basis. In addition, they may not have given the final numbers, and there may be some late adjustments. So you can slot the late adjustment balances in here, and you'll get the updated ECL amount. So once again, how does MAELA work? You create a free account, you download the templates, you upload the completed information, and you receive the report. Everything runs in the background. It's a service. There's no software for you to learn. There's no software for you to install or to keep up to date. We've got all the models. We've got the economic forecasts for the different countries. We've got the different ratings, and we've got the different tools to process things really quickly. We combine 60 months of separate age analysis into one data file. We remove the credits. We go through the decision matrix on the loans to work out what needs to be done. And that's it. The world's first accounting measurement platform. The benefits are efficiency. You save time, you only touch it once. You know that things are going to be technically correct. There are different options where the cost would match your needs. You choose. It's easy to achieve results. We reduce the stress and prevent bugging the clients. There's no cost to register. And in fact, for those people who are on the webinar, we know the firms that you're from, and provided you register fairly quickly, I think there's about a 30-day period at which you'll get a 60% discount to run any of your items through, and we urge you to at least try that out so that you can see the benefits. Right, we've got some time for questions and answers. I don't know if anyone wants to put something on the chat, or if there are any specific areas.
Rosh, if someone wants to talk, then I can unmute them, so they can just raise their hand and I will unmute them. No problem with that. So if everyone is okay, or do you have any questions, you can write it down on the chat or just raise your hand so I can give you time on the microphone to communicate your question.
Harry, there was one question. That came through from our previous webinar that was really quite interesting, and that was how do you get your trade receivables details? And in reality, on just about every accounting package, there's an option to export the month-end age analysis, and you would literally just choose for December, for November, and you just go backwards to export it. It generally takes a minute or two. So even if you're exporting 60, it's probably just an hour or two's work to get all that information done. Christos just asked, what is the cost of each calculation? So if you go onto our website, maela.biz, there are different elements in the solutions page for small companies and IBCs, and there's a package for them for a number of different measurements, and that package is the maximum that an IBC of a particular size will pay. I'll get back to that in a second. For the auditors, or for anyone who administers companies and does all the accounting for them, there are bulk pricing and packages available as well. So if someone just wants to use it once, they'll pay more than someone who puts a number of measurements through the business. And in reality, at the cheapest end, a measurement could be about €30 if it's in bulk. And it really depends if you want a proper expert report for a listed company, and we've got to interact with them and interact with their board and auditors and do a complicated model, it may be a lot more, but everything is really available on the web page. There are too many different options to be able to go through. The one thing to bear in mind is that the express service is the quickest one. It really doesn't rely on an analyst on our side having to touch it. So it's the most affordable one. So that's the express service. The high assurance service looks at different level of detail, gets reviewed by an analyst as well, and also has a slightly different report and a slightly different focus. But Mariette has pasted the web address at MAELA.biz for auditors, and there's also a separate one for companies and a separate one for small companies and IBCs. So if any of you are CFOs of listed companies or you have clients that are listed companies, they would look at pricing for companies. Auditors do have a slightly different report and very often get cost benefits because of the volume of items that you put through. And for an auditor, we would also give a range report. A company would just get a point report. Christos, in addition to that, I don't know if you're an auditor or a CFO, but from an audit perspective, we would also be interested to see which working papers you've traditionally been doing, and we'll take them and upgrade them as well so that they are fully compliant and they get generated as part of the process. So we don't just want to give you an answer, we want to save you the time of having to produce all these working papers and keeping your people up to date and investigating and the review process and that entire thing. We want to take that away. Right, we'll distribute the slides to everyone afterwards. We'll also have the presentation available as well. And I think that, as I said earlier, every time I listen to Lawrence, I am almost overwhelmed by the way that he speaks, the depth of experience, and the way that he describes things in a real world way, not in an IFRS standard or accounting way. We would, as members of the accounting community, we appreciate giving back, and we also get the benefit of brand recognition, name recognition, and improving our business. We are very happy to take suggestions in other areas that you would like to cover, and are very happy to do ongoing webinars that deal with areas, even if they are 15-minute sessions focusing just on a particular area, and you can distribute it to your different team members. And from us, Evharisto, sorry, Dimitri asked, is the cost per loan or per group of loans? Dimitri, it's actually per loan. And the reason for that is part of the loan is looking at the risk of the counterparty. So for each one of the companies that's borrowing, there is a different balance sheet that needs to be assessed for its probability of default and its loss given default, as well as some of the terms. So where we're doing something for trade receivables and for a loan, there may be a smaller cost. You're not going to pay double because a lot of the work gets shared. If there genuinely isn't more work, we would bring the cost down, but very often it is 10 separate calculations. If we're doing it all for an audit firm, once again, it wouldn't be the 10 that you would look at. If you do 50 or 100 during the year, you would qualify for discount pricing from us. As a last point, both Harry and Mariette will be available at any point in time. You can make an inquiry through our website. You can make it directly through Harry or through info@maples.co.za. maela.biz. And we would love to engage with you. Each market and country is subtly different, and we need to make sure that we meet the needs of both your companies and your audit firms. So if there's something which doesn't quite fit for you, please don't say, I don't want to do this. Please either try it out or speak to Harry or Mariette. Let us understand what the issues are, and I have no doubt that we can provide a solution that meets your needs.
Yeah, sure. We are open for any calls or questions or anything someone might need regarding MAELA. So I think we have finished. I don't see any other questions, so I will stop the recording. Thank you all very much.
Thank you, everyone. Thanks, everyone. Enjoy the week and enjoy the weekend.
Yeah, you too, Roche. You too, Lawrence. Thank you, Mariette. Bye-bye, everyone. Thank you very
Bye-bye.
much.